Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. In this episode, we are joined once again by Director of ETFs Andrei Bruno to discuss the current third quarter in capital markets. Andrei provides valuable insights into the latest data, market trends, and investment strategies to navigate the current economic landscape. He starts by highlighting the importance of retail sales and inflation numbers this past week. He examines both US and Canadian data, noting a slight uptick in unemployment, but nothing concerning at this stage. He also touches on the divergence in market flows and how each country's yield curves are looking. When asked about buffer ETFs, Andrei acknowledges that they haven't gained a tremendous amount of traction. He explains that in a scenario where markets decline significantly, buffer ETFs are likely to outperform, offering a level of protection for investors. He then discusses the role of nuclear power in supporting the new developing AI ecosystem. He argues that nuclear power is essential for meeting increased energy demand while minimizing gas emissions, emphasizing its importance beyond just AI. Andrei closes off by sharing his cautious optimism about equity markets for the second half of the year, predicting that the US will not enter a recession this year, with these risks instead being pushed to 2025. He also answers questions regarding international equity exposure, the concept of deflation in markets, and future investments. This podcast was recorded on July 2nd, 2024.
Hi, Andrei. Great to see you.
Great to see you, and happy belated Canada Day.
Happy belated Canada Day, and happy third quarter, I guess. That's what we're going to talk about here.
Kick off the second half of the year.
Kick off the second half of the year. Let's go into shortened week. Quite a lot of data, actually, this week coming through. Some of it's already come through on the jobs front. We've got more to go. Put it in perspective of what you've heard, what you expect, ultimately what it means for the rate story is what we're getting at.
Yeah, so it's a good question. Obviously, been looking hard at the economic data on both sides of the border. So, things I routinely take a look at is employment, obviously. The retail sales numbers are obviously very important. Inflation numbers, obviously, everyone's been looking at for the last, feels like 3 years has been like the main data point that everyone's looking at. But to talk about employment a little bit, so if you take a look at the US and Canada, on both sides of the border, we have seen unemployment tick up a little bit, nothing concerning per se. On the US side, if you take a look at the JOLTS numbers, which is job openings numbers, they have been steadily trending lower, although we just got a
slightly hotter one
today. Temporary workers, also same trend, been trending lower. That's typically been kind of a leading indicator to the rest of employment. When we talk about Canada, we take a look at the employment numbers. As I mentioned, it has been ticking up a little bit. If you look at the last print, it was positive, but loss in full-time jobs, and all of that was part-time jobs. So generally not a strong trend for Canada there. Again, nothing, no alarm bells, ringing just yet in the employment market. As we know, it's typically a lagging indicator to kind of overall GDP growth.
Sure.
But to talk about GDP for a second, first quarter was a little bit soft in the US, still positive, pretty soft in Canada as well. So again, no alarm bells, but there's a little bit of caution that needs to be exercised.
So I wonder if we talk about divergence or flows first, because they kind of fit together for the Canada versus the US. There is obviously the divergence, the interest rate story, and it leads to how you invest. So I'll throw it to you. Do we talk about divergence to talk about flows, or talk about flows to talk about divergence?
Let's jump into divergence, because we can kind of pair it back to the economic data a little bit. So if we think about Canada, and why don't we talk about the central banks quickly, because there's already a divergence there. So as we know, Bank of Canada got an interest rate cut in. The next subsequent CPI print was a little bit hot, so the timing on that, we can debate that, but nonetheless, inflation is under 3% in Canada. And just to remind viewers at home, in Canada we have a slightly different framework. We have a 1% to 3% band for the Bank of Canada, whereas in the US they have a 2% target
for inflation.
Inflation. So again, we are within that band. We are seeing some softening metrics in the economic backdrop in Canada. So the Bank of Canada did cut interest rates. Now the big conversation around the Fed is the Fed going to cut? How many times are they going to cut? I'm biased towards, 1, maybe 0 cuts this year.
Okay.
And that's predicated on the economic backdrop. Like we mentioned, GDP is a little bit slower, but it's still positive. Inflation is still above their 2% target, although trending in the right direction. Equity markets are doing very, very well. The consumer is still doing just fine. So there isn't a lot of, not a lot for Powell to bite into in terms of give that impetus to cut interest rates. Again, things can change. We're just starting off the back half of the year. It's very possible things start turning around. Inflation gets to that 2%. We see some softening in the labor markets and the overall economic activity in the U.S. and we do get a cut in. But I would be biased to say that would be late Q2, maybe not. No, sorry, late Q3, if not early Q4 for that potential first cut there.
So let's go directly to equities for a second here. So what does it do for the equity story if we don't get a cut? I mean, it means that things are surviving with higher rates and things are somewhat powerful.
Yeah, I mean, if equity markets have been doing just fine. If you take a look at margins, they've been good. Earnings have still been fine. We haven't seen a lot of earnings revisions lower, which typically as the year goes on, we start to see those come in. They haven't quite come in yet. We're going to get earnings season coming up for Q2, so it'll be interesting to see the numbers there. But again, I think it's going to be an earnings-driven market, and it has been all year, and it'll continue to be so. So again, if earnings can hang in there, even if we don't get any cuts, I mean, I think we'll just kind of continue this bull market trend that we're seeing in U.S. equities.
And that speaks to the flows. So that's what you're seeing. I mean, is that the flow story?
That's just it. So if we take a look at ETF flows, we kind of use it as a proxy of where money's generally going in Canada. It's been a U.S. equity story this year. So equities have been outpacing the other asset classes, whether it's fixed income, mixed allocations, or alternatives. If you get more granular into those equity flows, that's just it. It's been, the large lion's share have been U.S. equities. Coming in second place, international equities, and then kind of in third place is Canada. I know international equities kind of big bucket there.
Sure.
But nonetheless, that's what we've been seeing, and we've continued to see that, throughout the entire year. Fixed income last year, fixed income flows were kind of number one. We're seeing a bit of a reversal of that. What I want to remind viewers as well, though, last year, a large portion, I think somewhere around 50 to 40% of those flows were in money markets and HISAs.
Right.
We've seen a big reversal this year, given where short-term rates have been going in Canada. Obviously, with the cuts, they've been moving lower. So we are seeing a little bit of rotation of kind of longer duration assets, but I don't think anyone's diving headfirst into duration. And that being said, if you take a look at what the yield curve's done this year, right. Year to date, yields are higher on the belly to long end of the curve in Canada, they've moved down on the short end, obviously, on the back of the rate cuts. But again, the Canadian curve's still signaling a potential recession. Right. We're still seeing rates move lower. I'd say, between the front end of the curve all the way out to the belly of the curve, twos out to tens, we're still seeing rates move a little bit lower in Canada.
And that is housing/mortgage story?
Yeah, so the mortgage story, this ties into kind of the general thesis around Canada as well, and a divergent factor between Canada and the U.S. is if we take a look at the mortgage market dynamics. So again, in Canada, we do have a lot of renewals coming up next year, and in 2026, I think a large portion within those 2 years. Most of those folks renewing at current interest rates are going to feel a pretty large increase in their month-to-month carrying costs on their house. To contrast that with the U.S., most of the mortgage, I think, well up in 90% are fixed and termed out to 30 years. So the interest rate sensitivity between the Canadian consumer and the American consumer is much, much different. Right. That being said, on a consumer debt level as well, that does not include mortgage debt. This is all other types of debt. The Canadian consumer is a lot more levered than the U.S. consumer. So again, Canadian consumers are very, very sensitive to interest rate changes.
So in order to invest into the interest rate, but the idea of taking a look at bonds because you can clip coupons at a high level, I mean, we started out the year, everything going into equities because it looked like there were going to be 6 cuts at the beginning there. That was, the market consensus. That slowed to a much slower number of cuts, and therefore rates are higher. Does that make bonds more attractive to some investors at this point, thinking like, okay, maybe we're not cutting as fast as we thought? Maybe there's some
Yes, certainly. To your
yield.
Point, you're starting off at a higher yield, right? Yeah. So, before, when yields are at 2%, for example, on an aggregate bond, 2-3%, if you got a little bit of raise in rates and you had a longer duration, it was very easy to pull a negative year. Right. So right now you are starting off at a higher base. In terms of Canada, the duration story might make a little bit more sense simply because, there's a higher probability we could enter into a recession, which theoretically you would see kind of yields move lower, all along the curve. To remind viewers, kind of the long end of the curve is an inflation, GDP driven. Those yields are driven by those factors. Whereas the U.S., you could get in a scenario where things just kind of stay put. If the Fed doesn't cut, and a lot of the other macro factors don't change significantly, we kind of keep churning on here, you still do have the risk that rates might move a little bit lower, belly out to the long end of the curve in the US. Right. I don't know if that, I would say that risk is a lot more reduced in Canada. Inflation's trending in the right direction, GDP's heading in the wrong direction. Yeah. So I think if you're looking purely from a capital gains perspective, Canada, I might be biased towards Canada within that regards. If you take a look at the shorter end of the curve, which has been moving lower, so going up to 2 years, that part of the curve has been doing really well. So if you're looking at some short duration mandates, those have been doing well in Canada as well. Yes. Because that's where rates have been moving the most.
Okay, so fascinating. So if you were to put a few things together, tell us a little bit about your ideal positioning, basically. I mean, you're head of ETFs, so there's lots of different levers to pull there. But ultimately, it sounds like the U.S. equity story. And then where's the place for bonds? How does that?
Yeah, so for me, U.S. equities, I'm biased to overweight U.S. personally, underweight to Canada. When you take a look at bonds, I wouldn't say I want to be underweight duration per se in the U.S., but I'm personally right now, given kind of what the Fed's doing and where the economy's going, I don't feel like I want to be overweight duration in the U.S. In Canada, again, it's really about, you don't want to time the market or time the recession per se. But again, I think duration in Canada, the risks seem a little bit better just based on if we do get the recession. Obviously, duration historically has been your friend in that scenario. So again, I would be, either in line or slightly biased to a little bit longer duration in Canada.
There's a great question coming in, and it speaks to perhaps not timing, but kind of being roughly in a place of protection. So what are your thoughts on so-called buffer ETFs? Do you see these as an industry trend and, maybe sort of flesh out their use?
So we've seen quite a few of those come to market recently in Canada. They're over the last couple of years. They haven't gained a tremendous amount of traction. Again, the buffered ETF is going to work potentially in sideways markets because there you're buying a put, you're selling a call. So you're driving a little bit of income, but you also have that protection in there as well. We haven't seen a ton of pickup in those. There are other products that are purely protection based where you can get the full upside, but you're capped on the downside. The problem there is in an up market, you're still going to underperform because you're paying that premium for that put. Right. In this scenario, if markets go very down in the buffer scenario, you are likely going to outperform. You got that protection in place. I mean, it really depends where those protection levels are, of course. Sure. If your protection level's at 20% down and you go 19% down, you're going to underperform the market. Right. So ultimately with those products, I think what's really important is do your due diligence, know where your protection levels are, know where those calls are being written on the top, where your participation, and you really just have to weigh out the risk reward for kind of what your views are on the market and where you think things are going.
It's fascinating because if you broaden out to a different type of, I guess that's an element of diversification, but there are a lot of much broader versions of diversification. The all-in-ones certainly fit in that. Why don't you sort of, we've talked about them a lot. I think a lot of people understand, what they are and which ones might be for more conservative versus regional and so on. But just sort of the theory of that diversification in a market like this.
Yeah, so it's a good question. So we can talk about the all-in-ones first. I wouldn't mind quickly touching on liquid alternatives as well. We will,
for sure.
So in terms of the all-in-ones, the whole idea there is to have this diversified pool of assets, whether it's fixed income or equities, and diversification within asset classes as well. So on the equity side of the ledger, and to remind folks, we've got 4 of these mandates. We've got a conservative, a growth, a balanced, and an all equity. So on the equity portion, you get geographic diversification. So you're getting U.S., Canada, and international in there. 50% U.S., 25% Canada, 25% international. And within the fixed income sleeve, you're getting predominantly Canada, but you're also getting some global bond exposure in there. So again, the whole idea is, the whole point of diversification is if you look over an investment cycle, it's to smooth out that path, right? It's to avoid, stepping on any pointy objects and having over concentration in any particular area of the market. So that's what we've kind of endeavored to do within these products. Again, is to give investors that smooth investment path over an investment cycle. And the reason I wanted to quickly talk about liquid alts as well, because if you think about correlations, liquid alternatives are one of those things where we're looking for, an asset or a pool of assets that show a little bit different correlations relative to equity markets. So, depending on what you're looking at, if you're looking at a market neutral, which is going to have zero correlation with the equity market or close to, or zero beta, as the name would suggest, to the equity markets, or long short alternatives that may have beta less than one, may have a beta over one, depending on kind of what the manager is looking at. But these are also other types of products and solutions you can look at for some diversification in your portfolio. So non-traditional asset classes that can provide some diversification benefits.
Yeah, and it's really interesting over the last sort of 3 years where we've had so many different types of markets, really, that these alts have done so well. I mean, it's just interesting because they've really had a bit of a microcosm of kind of everything thrown at them.
Yeah, exactly. And, as with everything, obviously, when you're looking at liquid alternatives, some of these strategies can sometimes be a little bit more complex.
So which are they? You've got
so
there's versions of long shorts, but
we've got our global value long short, managed by Dan Dupont, our market neutral alternative, managed by Brett Tilley. Dave Way's long short alternative, and we also have our Canadian.
He joins the show on Thursday.
Canadian long short alternative managed by Rutu Kumra.
Yes.
Again, as with all these liquid alternative strategies, it's always good to take a look. Ask your advisor, go online, do your due diligence, and kind of see what the risks are, what it's trying to do, how it might help your portfolio, if at all, to diversify.
Yeah. Fascinating how this all works. Let's come back around to the consumer. I mean, I'm going to throw this at you. Actually, one of the things that Jerome Powell just said in this press conference that he's doing, he's on stage in Europe talking to other central bankers, and he mentioned the word deflation. Of course, the market is, because everyone combs his remarks for any new words. That's a new word, actually, for him. What do you think of that? There's been, I mean, the market has reacted.
It's a bad word for economists. They don't want to hear.
It's a bad word for economists.
As anyone.
How about to invest it?
As anyone who's taken Econ 101, they tell you that disinflation is not good.
Right.
Not good for consumption. I think if you do get a prolonged period of disinflation, it obviously on aggregate isn't good for the general economy. That being said, I think we've seen everyone's purchasing power eroded by about, I don't know, somewhere around 20%, give or take. Don't quote me on that exact figure, but
yep.
we've seen everyone's purchasing power erode quite a bit. I think if we get a short period of disinflation, I don't think that's necessarily a negative thing for the consumers. Now, if you think about kind of businesses,
that's fascinating. Just saying that, because that's not. Yeah, we don't hear that.
So I think for businesses, I think the main idea is it's a question of, is it going to affect that top line? Right. Are we going to see those consumption? Are we going to see consumption patterns change as a result of the disinflation? Mm-hmm. Maybe around the consumer discretionary, there might be some more pressures there. Consumer staples, I think a little less so, because at the end of the day, those are things you need. You got to buy your toothpaste regardless. Yeah. If toothpaste is going down 5% a month, you still have to brush your teeth every day. Yeah. So again, so it might affect different areas of the market differently. But the main question is going to be, is are corporations going to be able to maintain their margins in a disinflationary environment? I think that's the main question. If they can maintain their margins, top line doesn't take a massive hit, then I think the equity market can hang in there even in that environment. Again, short period of disinflation. Not talking about 2-3 years of disinflation.
And again, let's just take it as like a case study. How do you invest disinflation? It's the consumer. Consumer discretionary? In theory. I mean, this is a theoretical discussion.
Over consumer staples, personally,
right.
that seems to be, I think demand is going to be a little bit more inelastic in the consumer staples relative to the discretionaries. So I think areas where demand is more inelastic would probably be less affected.
Okay, really, it's just interesting because he's mentioned it. Now at least we get you to kind of parse that out for us, right? I appreciate it.
Commodities are up this year, though.
Yes,
so
I was just about to ask you for commodities. So if you need help with protection against inflation, one of the places to go is commodities. To what extent is that something that you're looking at?
Certainly looking at a little bit more. I mean, if we go back to, we had a Beverly Hills event where many of our PMs were speaking. This was back in April. And I feel like for the last 3, 4, 5 years, we haven't heard the word commodities come up at all. But all of a sudden, we had a handful of managers starting to talk about commodities, saying commodities are starting to look interesting right now. Maybe there's something there. And a lot of that, I'll try to summarize. There's many speakers, but I'll try to summarize kind of the crux of the argument is, we've had super low commodity prices. There hasn't been a lot of development of new wells being drilled for oil and gas. There has been new mines coming online. So
this is a global story. This is Canadian.
A global story. Yeah. So the whole idea is that we do get some sort of uptick in demand for commodities. It takes time for supply to catch up. It's not, you don't just turn on a tap and the oil comes. You got to drill, you got to pull it. So the thesis there was any uptick in demand could lead to upward pressure on prices. Right. So that would certainly fight the disinflation story, yes. Certainly. As we know, all those raw materials are the inputs for everything that gets produced. So again, and just to tie it back, so if that thesis does come to play, I don't think we need to worry about disinflation.
Okay. And one of the particular commodities that was discussed quite a lot was actually nuclear. And this has to do a lot with the discussion of AI, how to power a brand new ecosystem and really an industrial revolution, if that's the way you want to describe it. But how to power that, and nuclear seems to be one of the ways.
Yeah. So and I think Mark Schmel mentioned this. I think last year actually, and again it was on the back of this AI revolution and the amount of computing power and energy right. needs we're going to need to fuel this new AI powered world. And the simple argument is there's kind of right now, current technology, there's only one way we can achieve that increase in energy demand while also simultaneously not contributing to greenhouse gas emissions, right. and that's nuclear. Right. So I think a longer term thesis, again, that I tend to agree with is the need for more nuclear as we move forward to again satisfy the energy. And it's not just AI; it's also, if you think about developing nations as well. We think about the industrialization of India. And other nations, like the energy needs are only going to go up for the globe. And how do we do that without simultaneously putting more CO2 in the atmosphere? I think nuclear is a good solution for that.
We have some uranium in Canada.
We do.
Yeah.
We have quite a bit, actually.
Yes, we do. Yeah, it's a very interesting story. Tell me a bit about Europe. Europe's, it goes back to where Jay Powell is today and having his discussion. There's been lots of discussions about how it's been left behind. Maybe this is a good time and so on. The US dollar is what it is. Do you buy that?
Yeah, Europe, there's a lot of structural issues in Europe that they need to figure out. There's obviously a lot of elections coming up in Europe, mm-hmm. so that could change things for better or for worse.
It's hard to know, but we look at the inflation. So just look at the inflation story. Yeah.
Yeah, the inflation story. I think that the thing with inflation too is I think a large part of inflation is kind of a global story generally. Like, okay. If we look globally, inflation kind of went up everywhere. Yes. And now it's slowly coming down everywhere at different paces, mind you. I think Europe they're in a tough spot too, because their economic growth isn't quite, going as fast and up and to the right as they'd probably like, but they still have this overarching inflation story. Yeah. So they're kind of in this tough,
harder to grow out of it.
I don't want to say stagflation, but close to it.
Yeah.
So they're in a bit of a tough spot. So again, I think they're further ahead than us in the kind of the economic cycle. So they're probably kind of closer to the bottom of things. It'll be interesting to see if and when they can kind of pivot out of that, and if there'll potentially be some opportunities there. Okay. Again, valuations are at a discount to the US, and historically they are. So Europe might be interesting.
A bit later on, or now?
A bit later on.
Okay.
I'm sure there's some eyes on it right now. I don't know if I'd dive in head first just yet, though.
Okay, interesting. Question coming in. You touched on this earlier, but just swing back to it, and maybe in terms of Canada versus the US, do you see a market correction on the horizon?
For Canada or the US?
It's a broad question, so I guess you can go at it either way.
So Canada hasn't really been going up a ton this year. Valuations aren't too stretched. I'd say valuations are I wouldn't say they're stretched in the US, but they're certainly rich relative to kind of historic norms. That being said, earnings are keeping up, margins are keeping up. So, if as long as those hang in there, the valuations aren't too unreasonable.
Yeah.
That being said, if you look at the S&P chart, it has gone up and to the right at a pretty aggressive angle this year. So
it looks like a Swiss Alp.
Yeah, exactly. Yeah. So, with that in mind, just the fact that we've gone up so much, there's always the concern, like the chartist in me looks at that and says, there could be a scenario where people are saying, you know what, we've gone up, we got a lot of cap gains, let's sell and see what happens. So I think there is that risk that does exist. But in the absence of, earnings crashing, markets crashing, like you might get a little pullback, a healthy pullback, 5, maybe even 10%. Although, if earnings and everything are hanging in there, I don't know if we'll see that much unless everyone just heads for the exits.
But so just climb the wall of worry, maybe?
Yeah, it's just, when things go up so fast and so, aggressively up and to the right, you do get a lot of people who say maybe it's time to, take some gains, take our chips off the table and reevaluate. So that could very well happen.
Really, really interesting. When we go back to sort of the international story, again, just take that a bit broader, because there are lots of different mandates within Fidelity that we'll take a look at, specifically Europe, but then the international story more broadly. Tell us a little bit about what you like about that, considering that it's where some exposure on the equity side is.
Yeah, international is we're looking at a lot of different markets here, whether we're looking at EM. EM's obviously been out of favor and had a tough time, for a couple of reasons. Obviously, borrowing costs in US dollars have continued to go up, which has in turn affected the interest rate differential between EM currencies and the US. I think over the last couple of years, US is probably maybe the number one currency, certainly up there in terms of the best performing currency.
And it's the flight to safety. So if anyone's concerned, there's always that question of, even if you go further afield, if something happens, you're going to probably see a rush back to safety, no?
Well, that's just it. And, safety currencies historically have been US, yen, and the Swiss franc. The yen has absolutely cratered against the US dollars this year. So it'll be interesting. Japan is starting to get a little interesting again. I think they finally got back to the 1980 levels of their stock market, I think, 4 or 5 months ago. I don't know if they've pulled back since then. But it's certainly starting to get a little bit interesting again over there in Japan. China's kind of just sputtering along. They obviously went through their contraction or, their slowdown, and they're kind of coming out of the other side of it now. But again, Japan is starting to get a little bit interesting.
Okay, interesting. But if I had to sort of say, look, the one message, where do you come out on that? What is sort of the main message, the investment idea that is showing up in flows, but also, I guess, is your opinion for now?
Yeah, what I would say for the back half of the year, I'm cautiously optimistic on the U.S. equity markets. My base case is not that the U.S. is going to enter a recession this year. Yeah. I think that risk has been pushed to 2025. And I think for Canada, I think there is a risk we can enter a recession this year. Could crop up in Q1 of next year. But the risk is certainly higher on the Canada side. But for now, again, cautiously optimistic, for U.S. equities. For fixed income, again, Canadian, I think there's opportunity for cap gains. If the economic data continues to deteriorate, we could see a potential for cap gains there. On the U.S., my base case would be kind of status quo on the yield curve. Again, assuming, the economics continue into the year end. Again, Chairman Powell comes out and says, I'm going to cut rates. You're probably going to see the yields move lower along that curve.
Andrei Bruno, it's great to have you set us sail on the third quarter. Thank you for joining us.
Thank you so much for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.